Revenue is vanity. Profit is sanity. The income statement shows exactly what is left after every cut. Revenue is the top line. It is the total money earned from selling products or services. If you sell 1,000 widgets at $10 each, revenue is $10,000. Revenue is recorded when earned, not when cash is received. If you sell on credit, revenue is recorded immediately, even though the customer will pay later. This is accrual accounting. Revenue is the starting point, but it does not tell you profitability. A company can have high revenue and still lose money if expenses are higher. Revenue is important, but it is not the whole story. What matters is what happens below the top line. Cost of goods sold, or COGS, is the direct cost of making the product. For a widget company, COGS includes materials, labor to assemble the widget, and factory overhead. For a retailer, COGS is the cost of buying inventory from suppliers. For a software company, COGS is minimal, maybe server costs. COGS does not include salaries of the sales team or rent for the office. Those are operating expenses, which come later. COGS is only the cost directly tied to producing the product. If you sell 1,000 widgets and each widget costs $6 to make, COGS is $6,000. COGS is subtracted from revenue to get gross profit. Gross profit is revenue minus COGS. It tells you, is the product profitable? If revenue is $10,000 and COGS is $6,000, gross profit is $4,000. Gross profit margin is gross profit divided by revenue, times 100. 4,000 divided by 10,000 is 0.4, times 100 is 40%. Gross profit margin is 40%. This means for every dollar of revenue, 40 cents is gross profit. The other 60 cents went to making the product. Gross profit margin varies by industry. Luxury goods have high margins, 70% or more. Grocery stores have low margins, 20 to 30%. What matters is whether the margin is competitive within the industry. If gross profit is negative, the product is not viable. You are selling for less than it costs to make. Operating expenses are the costs of running the business, not directly tied to making the product. Operating expenses include salaries for sales, marketing, and admin staff. Rent for the office. Marketing and advertising. Research and development. General and administrative costs, legal, accounting, insurance. Operating expenses are sometimes called SG&A, selling, general, and administrative. For our widget company, operating expenses are salaries $1,500, rent $500, marketing $500. Total operating expenses are $2,500. Operating expenses are subtracted from gross profit to get operating income. Operating income is gross profit minus operating expenses. It tells you, is the business profitable from core operations? If gross profit is $4,000 and operating expenses are $2,500, operating income is $1,500. Operating income margin is operating income divided by revenue, times 100. 1,500 divided by 10,000 is 0.15, times 100 is 15%. Operating income margin is 15%. Operating income is also called EBIT, earnings before interest and taxes. It measures profitability before financing costs and taxes. If operating income is negative, the business model is not working. The company is spending more to run the business than it is earning from the product. Depreciation and amortization are non-cash expenses. Depreciation allocates the cost of a physical asset, like a machine or building, over its useful life. If you buy a machine for $10,000 and it lasts 10 years, you depreciate $1,000 per year. No cash leaves the company each year. The cash left when you bought the machine. Depreciation is an accounting entry that spreads the cost over time. Amortization is the same concept, but for intangible assets, like patents or software. Depreciation and amortization are included in operating expenses. But because they are non-cash, analysts often add them back to get EBITDA. For our widget company, depreciation is $200. This is included in the $2,500 operating expenses. But we will add it back to get EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is operating income plus depreciation and amortization. For our widget company, operating income is $1,500. Depreciation is $200. EBITDA is $1,500 plus $200, which is $1,700. EBITDA approximates cash-like profitability. It shows earnings before financing costs, taxes, and non-cash accounting adjustments. EBITDA is used to compare companies with different capital structures. A company with high debt has high interest expense, which lowers net income. But EBITDA is before interest, so it shows profitability independent of financing. EBITDA is not the same as cash flow. It ignores changes in working capital and capital expenditures. But it is a useful proxy for cash generation. Interest expense is the cost of borrowing money. If the company has loans or bonds, it pays interest to lenders. Interest is subtracted from operating income to get earnings before tax, or EBT. For our widget company, interest expense is $300. Operating income is $1,500. EBT is $1,500 minus $300, which is $1,200. Interest expense depends on how much debt the company has and the interest rate. A company with no debt has no interest expense. A company with high debt has high interest expense, which lowers net income. Interest is a financing cost, not an operating cost. It is below the operating income line. Taxes are subtracted from EBT to get net income. The tax rate depends on the country and the company's structure. In the US, the corporate tax rate is around 21%, but effective tax rates vary. For our widget company, EBT is $1,200. The tax rate is 25%. Taxes are $1,200 times 0.25, which is $300. Net income is EBT minus taxes. $1,200 minus $300 equals $900. Taxes are the government's share of profit. What's left after taxes is net income, the bottom line. Net income is the bottom line. It is what's left after all expenses, COGS, operating expenses, interest, and taxes. For our widget company, net income is $900. Net income margin is net income divided by revenue, times 100. 900 divided by 10,000 is 0.09, times 100 is 9%. Net income margin is 9%. Net income is what's available to shareholders. It can be paid out as dividends or retained in the business to fund growth. Net income is the final measure of profitability. If net income is positive, the company made money. If net income is negative, the company lost money. The income statement tells the story of how revenue turned into profit or loss. Let us see the full waterfall. Revenue is $10,000. Subtract COGS of $6,000. Gross profit is $4,000. Subtract operating expenses of $2,500. Operating income is $1,500. Add back depreciation of $200. EBITDA is $1,700. Subtract interest of $300. EBT is $1,200. Subtract taxes of $300. Net income is $900. Each line is a checkpoint. Gross profit of $4,000 means the product is profitable. Operating income of $1,500 means the business is profitable. EBITDA of $1,700 means cash-like profitability is strong. Net income of $900 means the company made money after all costs. The waterfall shows where the money goes. Margins are percentages. They tell you how much of each dollar of revenue turns into profit at each stage. Gross profit margin is 40%. For every dollar of revenue, 40 cents is gross profit. Operating income margin is 15%. For every dollar of revenue, 15 cents is operating income. Net income margin is 9%. For every dollar of revenue, 9 cents is net income. Margins are used to compare companies. A company with higher margins is more efficient. It keeps more of each dollar of revenue as profit. Margins also show where costs are high. If gross margin is low, COGS is too high. If operating margin is low, operating expenses are too high. Margins are a diagnostic tool. 3 things to be precise about. 1. The income statement uses accrual accounting, not cash accounting. Net income is not the same as cash generated. A company can be profitable but cash poor. 2. The income statement does not show the balance sheet. A company can have positive net income but high debt or low assets. You need the balance sheet to see financial position. 3. The income statement can be manipulated. Companies can inflate revenue or hide expenses. Read the footnotes and compare to peers. The income statement is a tool, not the final answer.